So, good afternoon. Welcome to TaxAssist and welcome to Tax Planning for Individuals, the latest in our series of tax planning webinars that we've been running. Thank you for joining us this afternoon. Let's just start with some quick introductions. My name is Darren Moore. I'm Group Commercial Director here at TaxAssist.
And I'm Andy Gibbs, Senior Technical Manager for the TaxAssist Group.
Andy and I will be running you through a fair bit of content. I'll give you an outline in a second. The reason we're presenting, we've both got a practice background. I think between us we've got 40-something years in practice, something like that. I don't really want to think about that too much. At advising clients in a number of different things, including tax. So we just wanted to share with you our take on things that we've seen that we think are relevant from a tax planning point of view. And we also want to cover off things that are a little bit more topical, perhaps. So our content for today actually will be quite broad, and I'll just set the scene at the outset. Tax planning is by definition quite a broad subject matter. Some of you will have been through tax planning processes before, perhaps. So what we're going to try and give is a bit of a flavour of different areas of tax planning. Just bear with us. Some will be more relevant for you than others, perhaps, but we want to try and cover as many different things as we can. So what we're going to be looking at, in overview at least, is paying tax at the right rate. That sounds quite obvious, but actually tax can sometimes be an absolute measure, i.e. you pay at a certain rate. Sometimes tax planning can help. So that's what we really mean by paying tax at the right rate. We want to talk about capital gains tax because that's relevant for an increasing number of taxpayers at the moment. We'll talk about tax efficient investments and how that applies to most people. And then we'll give you a quick run through just some other services, some other aspects of tax planning that we think might be of interest to you. So quite broad content there, quite a quick run through, but hopefully that will help you. We'll give you a bit of background perhaps as well along the way. So who are TaxAssist? Some of you will be TaxAssist clients and will know all about us. Others perhaps are new to TaxAssist. So we're a network of accountants across the UK, roughly 220 accountants working out of about 370 locations. And between those accountants, we look after something like 77,000 clients, most of whom are individuals and small businesses. So lots of background there in terms of our role in helping those accountants and their clients. So lots of opportunity to share experiences, which is what we'll do today. We will go through a lot of things. We will go through some of it in overview. So we would encourage you, please, to ask some questions as you go along. It's going to be difficult for us to preempt all of those questions. So please do use the chat box. We'll try and get back to them at the end, and Andy and I will do a wrap up when we're finished, just to go through and try and pick up questions and sharing those answers around. So just bear that in mind as we go through. We will be recording this webinar as well. So we will be covering off as much as we can on that webinar. At the end, it will just be a recording of this plus some content. So please do bear that in mind. You can come back to this if you want to revisit. And please do, if you haven't, subscribe to our newsletter. You can do that via our website, www.taxassist.co.uk. Today is really about tax planning. Some of it is topical. Elements of it will be relating to COVID and everything that's happened this year. But it has been an incredibly difficult, challenging and unprecedented year. So our newsletter and our regular content via our website will be a great insight into some of the things that are happening and some of the advice we're giving to our clients off the back of it. So make sure that you subscribe if you haven't already done so. So that's a bit of an introduction. I think now we'll go into some of the detailed content. So I'm going to pass you over to Andy, who's going to talk through some of those subjects.
Thanks very much, Darren. We're going to start off looking at how we can help you here by looking at the amount of tax that you're paying on your income. All tax planning that we do at TaxAssist is really geared to try and make sure that you pay the least amount of tax that we can arrange for you. So all of it is aimed, and all tax planning is actually aimed around these basic ideas of making sure that you're paying tax at the lowest rate possible. So just to give a little bit of introduction and to start off with, we'll look at the sort of tax rates which most people will face in the UK as an individual. So there's a couple of rates which apply to savings and dividend income, which essentially mean that for most people with relatively modest savings income, relatively modest dividends or relatively modest savings, they possibly will be outside of UK tax. We can confirm that for you, but for a lot of savings income, there are some very generous allowances and reliefs. what we've got on the screen really is the rates that apply to what the revenue would term non-savings income. So that's things like your employment income, your sole trade income, and if you're a landlord, things like rental income. And you'll see that everybody, or for the vast majority of taxpayers, they'll be entitled to a personal allowance. So that's a small band where you pay absolutely no income tax, which in the current tax year is £12,500. After that, you then start to pay incrementally more tax. The more you earn, the more tax you pay. So we go from the 0% rate in effect in your personal allowance to 20, 40, 45%. So obviously, all tax planning starts with the idea that we want to make sure that you're not paying tax at these higher rates any more than can be helped. It's important to note that the tax bands on the screen are the ones that apply to the whole of the UK, with the exception of Scotland. So Scotland pays rates very slightly different to the rest of the UK, and we've put them up here. So you'll see that they're very similar, but they do have more bands and they do have more rates. And again, it's just important to remember that these rates apply to non-savings income, so employment income, landlord income, and self-employment income, but it wouldn't apply to savings income. They're all taxed at the same rates. There's some tax traps, therefore, that everybody wants to avoid. So if your income is hitting £100,000, one of the tax traps is that for every £2 of income over that level, then your personal allowance is abated by £1. So effectively that means you have a very high marginal rate of tax once your income hits above that level. And also it means that if you have taxable income of £125,000 or more, you effectively have no personal allowance because it's abated away. And the other headline to remember is that at the highest rates, Scottish taxpayers will pay income tax at 46%, and for the rest of the UK it's 45%. So the UK has quite a high tax regime which kicks in very quickly. We move to the bands very quickly. And you know, it's a nice sunny day today, and most people unfortunately only think about doing their tax planning right at the end of the tax year, and often it's too late. So you know, this is actually a good time, particularly as Darren said, with all the COVID stuff going on, to start looking at your circumstances and start planning a little bit to make sure that you're not paying any more tax than you need to. So there are some strategies that you could adopt and we could help you with to minimise your tax bill. From an income tax point of view, one thing that you could consider is to transfer assets from yourself to your spouse or civil partner. This is often done if your spouse or civil partner pays lower tax rates than you. So it may be that you have perhaps quite significant income, but perhaps your spouse or civil partner is maybe a home worker, maybe they're not earning so much money. And if you had, for an example, a rental property, you could potentially transfer that to them, or a share over to them, and then that income would be subject to their tax rates, potentially using up their personal allowance, using up their lower rates of tax. So that's a key area in any tax planning meeting that we'll have with you. If we can identify any of those tax savings, then it's something you might want to pursue. There's a few things to watch for. A gift has to be absolute, and you have to be aware that you are making a gift. It can't be taken back later. And there's a few other things to consider, but that sort of tax planning can work really well for married couples or civil partners, because the rules that would trigger some other tax charges are effectively relaxed for married couples and civil partnerships. So that's a key area of tax planning that may be worth exploring. The other thing to be really aware of is really try and hold on to your personal allowance. It's one of the biggest tax traps is once your income starts to go over 100,000, the combination of slowly your personal allowance being abated and the fact that you're paying tax at 40% effectively gives you a marginal rate of 60%. So it's a very high area to be paying tax at. As I said before, on a sunny day, it's easy to forget this sort of stuff, leave it to the end of the tax year, and that will be too late for some planning. One key area that we can help you with is pension planning, because it is possible to make pension contributions, and that will actually reduce your rates of tax. It will reduce the rates that these higher rates kick in at. So pension planning is one thing we can definitely help with. The basic idea with personal pension contributions is that if you contribute £8 from your net after-tax salary, the government will give you basic rate relief of 20%. If you've done that, if you're an employee maybe, and that's what your employer has done, don't forget that you can claim the additional rate through a self-assessment tax return, or potentially by phoning the revenue if the amounts are relatively small. We can help with either of those situations. The important thing to remember is if it is possible to claim any of that relief, then definitely claim it, because it will reduce your tax liabilities. Just a note of caution, before you make any pension contributions, you should consider getting some tax advice, because there are some tax traps with that. The government have been very keen to restrict tax relief in recent years, so there's a number of barriers. If you contribute very high amounts, you could potentially get stung with additional tax charges. Most people will be able to contribute up to £40,000 a year, but that won't apply in every case. There'll be some people that will have reduced ability to make those contributions. Equally though, some people will be able to pay in higher contributions, and some people perhaps are looking at their exit planning, perhaps they're looking at some retirement planning, and they're looking at topping up their pension, and they're looking at putting in the maximum amount that they possibly can into their pension. So if you are wanting some help with that, then get in touch, because we can help make sure that you maximise the claim, that you put in the most that you can.
Andy, a quick question from me. There's been lots of speculation, hasn't there, about restriction of that tax relief for higher rate taxpayers. Do you think it's worthwhile if people are thinking about pension contributions, to do that sooner rather than later, just because there's that risk of that restriction to that tax relief?
I certainly think you're right. I don't think we've heard anything that would make us think it's going to get more generous.
Yeah.
There was some, as some people may recall, there was some movement last year where they made things slightly better, because there was a lot of outrage over doctors and high public sector workers being hit with pension charges. So I think you're absolutely right. The general movement of direction will probably be for restrictions. As with all of this, there's huge amounts of speculation about future tax changes, and there's always been an argument made that the system is either too generous or perhaps rewards the wrong people, maybe higher earners rather than lower. So I think probably most people think there will be at the very least mention of a review, and it may come sooner rather than later.
Yeah. Okay, so I guess the message there is none of us can predict the future. We're in unusual times, aren't we? But if this is something that could work and could appeal, it's probably worth talking to somebody about it sooner rather than later. We'll leave it at that, perhaps.
Yeah, exactly.
Okay, thanks.
So those are some of the planning techniques that we can help with income tax. And as I say, these are planning techniques we work with our clients to make sure that you pay the least amount of tax on your income. The other tax that's really something to be aware of now is capital gains tax. So this is the tax that's paid when you sell most assets. There's a few assets that it won't apply to, but the vast majority of assets that you sell will incur capital gains tax charges. So whereas before it's your employment income, your self-employment income, or your rental income, which is charged to income tax, we're now talking about capital gains tax. So that could apply if, for example, you're a landlord and you sell your rental property, or it could apply if you're a business owner and you come to sell your business, whether you're running it as a sole trader and you sell that trade, or whether you run as a limited company and you're selling those shares. One of the important first things we'll just talk about is the reporting regime. We're probably on a journey over the next few years in all taxes to move to a digital tax system where all taxes will be reported in real time, in effect, or as near as the government can get, or at least quarterly. And capital gains tax is one of the first taxes that has started to move down that path. So from the 5th of April 2020, if you're selling UK residential property and you have capital gains tax to pay on it, you have to report that to HMRC and pay the tax within 30 days. And if you don't, unfortunately, you could be liable to a penalty.
And that's quite a big change in terms of the regime before, isn't it?
It's quite a massive change, and unfortunately, it wasn't as well publicised by the revenue authorities as perhaps it should be. So if you are in a situation where you're going to be paying capital gains tax on residential property, which generally will be for the landlords, but it might not be, there may be other instances where it could hit, then there is a special way that that needs to be reported. And as we said, it has to be reported within 30 days of the completion date. So if you are in that situation, please do talk about us. We can help explain the rules. We can handle the reporting for you. We can do both the calculation and we can do the submission on your behalf to HMRC. It's also important that in recent years, as well as changing the regime for UK residents, they've been slightly more aggressive with non-residents, because if non-residents sell or dispose of any UK property or land, it's highly likely that they're going to have to report that disposal and pay tax to HMRC within 30 days. And that's even if no tax is due. So there are two key things to remember. In the first instance, we're talking about UK residential property where there is CGT. Where there is CGT, report it within 30 days. For non-residents, then it's pretty much any disposals of UK land and property, whether it's residential, commercial, whether it's direct or even in some cases indirect holdings. So if you have any queries or concerns about disposal of land and property, then get into contact with us because we can handle the reporting for you. As we said earlier on, what we're trying to do is make sure that you pay the lowest rate of tax that you possibly can. And a key area of tax planning when it comes to business sales is entrepreneurs relief. The rates of capital gains tax are slightly different to income tax. There's 4 rates. There's effectively 10 and 20% for most assets. And then there's rates of 18 and 28%, which applies to sales of residential property. So the rate that you pay tax will depend on, amongst other things, the amount of income, the amount of basic rate band you have, so your income levels, and it will also depend on what you're actually selling. So there is a special relief called entrepreneurs relief, and if you can lock into this relief, effectively it will apply just a simple 10% rate on any gain. And what we mean by a gain is we mean the amount you sell something for minus the amount that you paid for it. So if you sell something for £200,000, paid £100,000 for it, you would have a £100,000 gain. Just as with income tax, there is an annual exemption for capital gains tax, which we'll come on to in a bit. So there'll be some of your gain can be paid at 0%, but if you can lock into entrepreneurs relief, the rest can be paid at a flat rate of 10%, up to a lifetime allowance of £1 million. So if you're selling your business, or you're selling shares in a trading company, you should check to see if you can make a claim and save tax. So again, we can help with that if you need any assistance. Another area to watch is for main residences. If you sell a main residence and it's been your main residence and your only main residence throughout the period that you've owned it, you don't have to pay any capital gains tax, because our homes aren't chargeable to capital gains tax, and you also don't need to report it. So with the sole exception of the non-residents, they would still need to make that report. But in the main, you won't need to do anything if you're living in a property. If, however, you own more than one property, we can help you consider making an election. There's a few things to watch here, but if you do own holiday homes or second properties, not rental properties, this is houses that you're using as your main home. So you may have one where you're working and another one that you're using on weekends. Then please talk to us as quickly as you can, because there's broadly a 2-year time limit which allows you to make an election to choose which one will get this really valuable relief to exempt it from tax. So if you have any properties that you haven't occupied, potentially there's an exposure to capital gains tax before you sell them. So again, speak to us beforehand, and we can help advise you what the tax due would be. Another area that you could consider utilising to save tax is making gifts to spouses or civil partners just before you make a sale. So this is an area of tax planning. So if, for an example, you're selling a rental property and you are going to be hit with these higher rates of capital gains tax at 28%, if your spouse or civil partner is in a situation where they would pay a lower rate of tax, then perhaps it's worth considering transferring the property to them and then making a joint sale. Again, there's a few tax traps to make sure that that's done properly. It has to be a genuine gift, and it has to be done before you've arranged to sell the property, and you have to be living with your spouse or civil partner at the time of the gift. But as long as those things are met, there is no reason why we can't look at potentially saving tax by utilising your spouses or civil partners' annual exemptions and lower rates of CGT. And that can save quite a bit of tax where one partner is the higher taxpayer. It's important also to notice that some of this planning won't work so well for unmarried couples. So again, whatever your circumstances are, please come and talk to us, because we can help you decide the best way to proceed. As we said, there is an annual exemption from capital gains tax, and that's £12,300. So most people in the UK will be able to benefit from that. So if you are selling assets where the gain is 12,300 or less, then you won't pay any capital gains tax on that gain up to that level. Again, it's also worth remembering that if your spouse or civil partners has any losses, so maybe in prior years they sold things at losses, then it is possible for us to utilise those losses. So again, a tax planning meeting will help us analyse all of this and work out the best way to proceed. Just like to also quickly look at some tax efficient investments. So if you are in the situation where you have some assets, some investments that perhaps aren't in tax-free wrappers, then one thing to consider from just a pure tax point of view is making use of ISAs. So ISA limit is £20,000 a year. There's various types of ISAs, so stocks and shares, cash ISAs. A financial advisor will be able to help you decide the best one to choose for you. But nevertheless, what we can help you do is make sure that you maximise putting assets into tax efficient investments where that works for you.
And this can just be people with, frankly, surplus cash that they're saving in normal accounts at the moment that could be moved over to these sorts of more tax efficient funds.
Yeah, but some people don't, again, as you say, think about it until it's too late, right to the end of the tax year. So just as with pension contributions, we can't carry these back. So these have to be done within the tax year. So if you wanted to take advantage of the ISA allowance now, then that's something to do. And as Darren said, we're in a regime which is potentially going to change quite a bit. And the allowances with ISAs are really quite generous at the moment. So perhaps putting it in early is going to stand you in good stead if they do change some of the generosity of the schemes. And as we mentioned before, pension contributions are very tax efficient. So again, if you need any help with maximising those or explaining how much tax you can save, then please do speak to us. There's a number of other investments where you can obtain some very, very generous relief. That must be said, you probably need some financial planning advice to decide if this is right for you. We can help explain the tax consequences though. And for some of these investments, there are some very attractive tax rates and tax reliefs that can be applied. So for an example, the enterprise investment scheme, qualifying investments can attract a 30% tax reducer. So if you invest £10,000, you'll get 30%, you'll get £3,000 tax reducer. And they will also be open to some capital gains tax planning because it can allow you to defer gains into those shares. So that's one very attractive opportunity that may be right for some people. As we said before though, you will need some financial planning advice to decide if that's right for you. We can help explain the tax consequences of investing in enterprise investment schemes, seed enterprise investment schemes and venture capital trusts. And we can also lend a hand with our tax consultants to help set some of these schemes up if you are interested in doing more than just making an investment. We'd also like to help you with any other services as an individual that you might have. You might be in a situation where you have land and property, you might be a landlord, and we can help with the reporting for you. We can help explain the differences between the new regime, between cash basis and how you report your income, or traditional way that you report that income. We'll also make sure that we go through your records to make sure that we maximise every claim that we possibly can. So you might not be aware of all the reliefs that can be applied. We'll go through your records to make sure that everything that can be claimed is claimed. We can also help explain the changes which are COVID related in relation to landlords which have occurred recently. So all areas of the UK have had some kind of changes to their land taxes, which is the tax you pay when you buy land and property. So this has opened up opportunities for some landlords to consider purchasing property and taking advantage of some of those tax savings. So in Scotland, the land building tax and SDLT in the UK and Northern Ireland, there are some advantages where there have been some temporary reductions which landlords can benefit from, but they will still pay some SDLT, it's important to notice. And also in Wales, there has been some changes there. They are not benefiting landlords in the same way as the rest of the UK. We can help explain the opportunity there if you are thinking of investing now, maybe you've been put off in the past. And we can also, if you have borrowings on your property, if you've got mortgages on your rental properties, we can help explain to you what changes are afoot and how the tax relief has been made less generous in recent years, and talk about the options that you could have. And we're also ready for any Making Tax Digital changes. As we said before, Making Tax Digital is still a change that will likely come forward. The Revenue have shown no indication that they're not going to go ahead with this. So we're ready for those changes. So if you wish to discuss any of those things, then please do come and speak with us. Also, if you're a business owner, we can help you make sure that you've got the right structure. So whether you want advice on running your business as a sole trade, or whether you would benefit from running it as a limited company, we can help with that. We can also help optimise it so that you extract your profits to save the most amount of tax. We can advise you on every relief that's possible to claim. And again, as with landlords, we'll run through your expenses, run through your books, make sure that every expense that can be claimed is claimed. We're just going to finish off with some of the COVID related issues that will be particularly relevant for individuals. If you are paying tax through self-assessment, you'll be aware that generally tax is paid in 2 instalments. One is due at the end of January, one is due at the end of July. These are interim payments which are based on a final year assessment. And that can be quite confusing the way the tax system works. So if you are wanting some help with understanding your tax obligations, please do come and talk with us, because of the cash pressure and cash crunch of the COVID crisis, the Revenue have allowed payments that were due to be made at the end of July to be deferred until 31st of January. So that's a great thing to have those payments deferred, but obviously those payments are still there. They're going to need to be paid. So if you want help working out a calendar of payments so that you make sure that you know exactly what needs to be paid when, then please do come and talk to us about that. Equally, the Revenue, if you are running a business and you are VAT registered, there is a deferral for VAT, which will run out next year as well. So again, if you need any help with cash flow planning or understanding what liabilities are falling due, please do speak with us. We mentioned before non-residents, and we can help you with the non-resident capital gains tax reporting, but we can also help you with income tax reporting. And there were some temporary changes to the statutory residence test, which is a body of rules which help you determine whether you're resident in the UK or not. And that has big, wide-ranging tax implications. If you're non-resident, broadly, you can avoid tax on your UK or on your non-UK income. And those changes to the statutory residence are really important to understand, because if you have been forced to stay here because of COVID-related issues and you haven't been able to get out, it may impact on your day counting. We may be able to claim those as exceptional circumstances. So if you need any help with that, again, please do get in touch with us.
Thanks, Andy. I think we said at the start that this was going to be quite broad, and I think Andy's just demonstrated just how much there is around tax planning from an individual's perspective. There are lots of different taxes there we've covered, lots of different aspects. Hopefully, at least some of that was relevant for you, and lots of follow-up questions I'm sure that can come from that. I just wanted to wrap up before we go to those questions about how we can help, just to summarise that really. I'm going to start with just the circumstances we find ourselves in. Obviously, the economy and us all as business owners, employees, individuals, we're all challenged by what's happening. And we've had just an unusual year, an unprecedented year in terms of everything that's been coming out. So a big task for us at this end has been to try to get messaging out there in terms of what this all means. There's been huge amounts of government intervention. There's been a whole host of new schemes that have kicked in. It's been really difficult keeping on top of that. So we've worked hard to try to support our accountants, our network, and their clients. And hopefully, for those of you out there that are clients, you've appreciated that. There's been an awful lot of communication because it has been such a challenging time. We will keep that going. We're not, unfortunately, out of the woods yet. None of us know what the future holds in terms of COVID. We'll keep our fingers crossed that there are better times ahead. But I think it's safe to say that there is going to be more challenge out there potentially. Logically, there'll be more government intervention. We don't know what yet, but there must be. But off the back of all of this, there will certainly be tax changes. Again, we don't know. There's lots of speculation. But there are some big holes in the government's coffers off the back of all of this support, and that's going to have to be repaid at some point. And the tax regime is really one of their main ways of doing that. So we are expecting to see tax changes. Our job is to keep our clients informed, because with change comes more requirements, more challenge, but it also presents opportunities as well. So that's our job really as part of tax planning, to see those opportunities and to help our clients. And we start that process by keeping you informed of what's happening. So I mentioned earlier our website and registering for updates. Please do that, because there's lots more to come, we think. What else can we do to help? We can certainly talk to you about any of these tax topics and look at meeting you to try to help you. There are planning opportunities there, and we can try and help support you and advise you to make sure that you're making the right decisions to minimise that tax liability. For those of you that have businesses or running trades, that move to digital is very real, and HMRC are looking at moving quickly over the next 2 years. So a lot of you who have not moved to proper cloud-based bookkeeping packages will need to do so, so we can help you move in the right direction and get those packages up and running. And please do make sure that you stay in touch. Don't be put off if you can't visit our shops. We know times are difficult, and we know that a lot of people are remote working, but we can still be contacted. We can be contacted on Zoom, Skype, phone calls. We're keen to stay in touch, so please do talk to us if you need to. So lots of ways we can help. We'll wrap up just by looking at questions, either direct questions or through the chat, just to see if there's anything there we can help with. So let's have a look at the chat first if we can. Tax bans applying to rental income from Shervin. First question there, Andy.
Yeah, so hi Shervin. Rental income of £20,000, I can take advantage of personal allowance for the first 12,500. Yeah, if you only had rental income of £20,000, the first 12,500 in 2021 would be covered by your annual allowance, and you would not pay any tax on that. After that, you pay tax at 20%. Assuming you're in England, they would be slightly different in Scotland. The next one is Joe Clark.
Yeah, Joe, you've asked, will we be detailing a list of what to claim as expenses through work? Not directly through this webinar.
We did one on sole traders, which listed some of the ones that could help you, Joe. And we do have information on our support site, on our website. So we'll get something over to you to cover that.
Yeah, and generally, I think for all of the audience, we are looking to build more materials off the back of these webinars with some more guidance, more specific guidance. So we will go back to your questions and send them out where we need to. And Shervin, I think you've come up with a second question there about rumours that capital gains tax will potentially increase after the next budget. And whether that affects plans to sell a property, accelerating plans to sell a property. That's a difficult one. if changes are announced, they tend to apply from that date to avoid planning opportunities, don't they? We'd be speculating, I think, Shervin, in terms of what the future holds.
Yeah, and I think it comes back to another thing as well, that although tax planning is important, the other thing is always to remember, don't let the tail wag the dog. Tax is just part of a strategy, and it might very well be that, Shervin, for you, or for anyone, that holding onto the property is still the right thing. So there's other things to consider, really. But we probably think that maybe taxes will rise at some point in the future, but given the economy is still in quite a weak state, perhaps not now. So there's a lot of uncertainty. I think you need to think about all of the things before you come to any conclusion on that. And unfortunately, we just don't have that crystal ball that we'd love to have.
We all like one of those, wouldn't we, at the moment? So yeah. There's one more question there from Marilyn that I'd just like to cover. Is there a time limit prior to selling a rental property you must give to your spouse? Will the HMRC not see this as a direct ploy to reduce tax bills? So is there any risk of that sort of artificial situation that can be challenged?
It's traditional tax planning, so it's not something that is attacked, Marilyn, by HMRC. The main things to remember is that when you make the gift, firstly, you have to make sure there's no negative consequences from the gift. It sounds silly, but you have to make sure that you're happy to make a gift to your spouse or civil partner. You have to make sure that that it will be exempted from any taxes on transfer. So that can take a bit of looking at. And you also have to make sure there isn't what they call a kind of a contrived step. So if for an example, you'd already say exchanged on your property, or exchanged on a deal, and then you try to transfer afterwards, the revenue would then say that that's kind of a bit of what they would term it as a nullity. So you have to make the gift first, a free gift, and then once you've done that, then go ahead with the final transaction.
I think this just demonstrates the need for planning, doesn't it? And that's often the way with tax. It needs careful planning because circumstances can and will differ. I think what we'll probably do, because we've got a number of people on this webinar and we're getting into some specifics now, what we'll probably do is we'll wrap it up there, I think. There are a number of questions that we've not got around to, and apologies for that, we've had a number that have come in. It is a broad and interesting topic. We will get back to you all individually with responses and thoughts. We've got all of your details off the back of you joining us today. So leave that with us, we will come back to you. Outside of that, I'd just like to thank you all for joining us. Hopefully that session was useful. Andy, anything from your point of view?
Just thank you for your time.
So thank you all. We will, as I say, respond to your questions. Hopefully we'll have a chance to see you again at a future event, and enjoy the sunshine. Thank you.